Welcome to HNWLifeInsurance.com's presentation on life insurance premium financing. Today what we're going to do is review a case that we recently completed and show you the model that we used to help the client get to a level of comfort so they knew exactly what was going to happen or what could happen in this premium finance scenario. So let's get started. What you'll see here is we've built in different illustrations within our model. These illustrations were developed based on conversations that we had with the client and what their goals ultimately were. You'll see here in version 1.0 what we've done is a single premium payment, and what that does is it allows the coverage to last for 5 years. This is a very simple financing scenario. They know that on the back end at some point they're going to have to put new premiums in or do some additional planning, but this is a great way for them to get started and really put off the decision of what needs to be done next till next year. In version 1.1 what we've done is we've done the same premium in year 1, but we've solved for the level pay premium from year 2 to the client's age 90. This was done based on the idea that they aren't completely confident that the insured will last beyond age 90, and so they're very comfortable with this assumption. Version 1.2 shows a different scenario where we took the same 561 in year 2, but we only made that premium payment in years 2 through 5, and it was determined that the coverage would last to the insured's age 84. And so what this does is it gives us a wait and see approach. If we get out to year 5, year 6, year 7, and mom's health is not as good as it is today, we can make a decision at that point whether or not to continue funding premium payments or what needs to be done. We put some other scenarios in here, but for purposes of this discussion we'll just focus on versions 1.0 through versions 1.2. Going here to our model, what you'll see is we've got different variables built in here, and so what this allows us to do is be very flexible with what it is that we're presenting to the client, and we actually take the client through this entire spreadsheet. They can ask us questions, we can make changes on the fly instead of having multiple scenarios printed on a static sheet. This allows us to change things as it is and gives the client a very nice feeling of comfort knowing what it is they're getting into and really what can happen. So let's look at the first thing. Here we have the illustration version, and this is really the versions that we just reviewed with the different scenarios. So you'll see here that we have that version 1.0 with the single premium payment. If I change this to version 1.1, it auto-fills not only the planned premium outlay but the changes in the cash surrender value along with the additional collateral required. Version 1.2 looks very much the same as version 1.1 since we're only looking at the first 5 years. We intend to be out of the loan in the 5th year. The client has forecasted that their earnings are going to be much greater in the next 3 to 5 years, at which time we'll pay off the loan and just continue to keep the coverage in force. The other neat feature here is we can adjust our borrowing rate. So if the client says, what happens if interest rates go to 6%? Well, we can adjust that to 6% and it changes the interest owed column. Currently we're getting this loan at 5.1%, so we'll just leave that there. The other thing is the advance rate. We won't get too much into advance rates today, but basically this assists us in determining how much collateral is going to be required. So if I have a 100% advance rate on the cash surrender value, you'll see my collateral requirement in year 1 is just under $163,000. If my advance rate were say 90% on cash surrender value, you'll see my collateral requirement will go up to $272,000. So this really allows us to show the client what is going to happen with the collateral based on the different types of underlying assets that we're having. And we've actually built in 2 advance rate scenarios here, one for the cash surrender value and one for other assets. So if they're going to pledge, let's just say marketable securities, or let's just say it's a bond fund and we get an 80% advance rate on bonds, we can build that in, and it'll help us to understand exactly what that's going to do to the collateral requirement. We might also just say, well, let's just leave it in cash and get 100% and keep that collateral down, that collateral requirement down. And so this gives us a lot of flexibility in communicating with the client and saying, hey, what type of assets are you thinking about pledging? This is the effect. If you do this, this is what's going to change. And so it helps in that conversation. Now, the other thing that this particular client wanted to do is they said, well, what's going to happen to our collateral? What's the payoff going to be? And so what we did is we built in a little feature here where let's just say they are in cash and we can get 2%. Well, the collateral is going to be on deposit at a bank, so our collateral requirement here equals our collateral requirement for purposes of determining the additional collateral. If it's sitting in a bank and working for them at 2%, they're going to make just over $3,000 on that investment for a total of $166 in the following year. Here in year 2, what we're going to do is we're going to add our end of year collateral values plus the additional collateral required in year 2, and we're just going to continue to grow that out. So as far as the collateral goes, what you'll see is it's only going to grow, it's going to grow very minimally over the 5 years. But you know what this allows us to do is if we have a client that's in the market and they say, well, I think I can get 6.5% on my money, I don't think interest rates are going to go up, what it allows us to do is calculate what their return on investment is going to be. So you know, if your money, if the money you have is going to outpace the borrowing rate, let's take a look at how that works and see what's going to happen to it. So this is a real basic look at one of the models we use. Hopefully you enjoyed this presentation. If you did, we'd love to hear from you. Please visit hnwlifeinsurance.com, drop us a note, join our newsletter, our monthly newsletter, or leave us a comment. If you're an advisor reviewing this and you're interested in maybe using this model for one of your presentations, definitely drop us an email. Somebody in our office will reach out to you and we can discuss the use of this model for your use. Thank you for your time, and again, we'll look forward to you in the next edition of hnwlifeinsurance.com webcast.